Hey everybody, Jimmy here. Welcome back to the channel. So in today's video, I'm going to do a trade breakdown. I put a trade on this morning. It's an options trade. I sold a put. I want to break it all down for you. It's on ticker symbol TTD, which is the trade desk. And I want to show you why I like the stock, what I liked about the price action, what the premium amount looked like, and kind of the whole thought process and my logic surrounding this trade. And then I'll go ahead and open up the charts. I'll go ahead and open up the options chain, and I'm going to show you exactly where I placed the trade and show you the outcomes of it so far. So why don't we get to it? Okay, I've got the trade desk, ticker TTD. I've got it up on the daily chart right now. And I just want to show you how I pick stocks when I'm wanting to sell a put. Now, selling a put, basically, if you're not familiar, I can link an Investopedia article below. But just really quickly, it's basically saying, when I look at this stock, you can see my position right here, $227.50 put. So I'm just saying that I don't think TTD is going to go below this point. I think that it's going to stay above this level between now and August 30th. Now the consequence of this is, if it does go below that level and we do hit August 30th, then I might have to buy 100 shares of this stock from someone else at $227.50. Even if the stock's at $140, I have to buy it right here. So the upside is, when you enter into this type of a contract, this options contract with selling a put, you receive a premium. And I'm going to open up the options chain and show you that premium and exactly how that applies to this trade. But for right now, let's just look at the price action of the trade desk, and I can kind of tell you what I liked about this trade and why I chose to enter this trade. So the trade desk, if I zoom out a little bit, you can see has had a lot of great growth. You can see the 200 simple moving average, which is this green line, it's been moving up. So this is an overall trending up stock. So I like that. Those are stocks I'm drawn to specifically for selling puts, because when I sell a put, I'm being bullish on the stock. It can remain neutral, go down just a little bit, or go up, and I would win on this type of trade. So with this uptrend in place, we can now come in here and take a look at it. We can see that the trade desk just had earnings, and they had an earnings beat. They were expecting 73 cents. Instead, they got 93 cents. So a very good surprise on that part. So what happened then is trade desk pushed way up, and now it's pulled back down. Now, one thing I specifically like to do, and this is just my opinion, but I love having the MACD on my chart for this, because if you look at this, I base a lot of my choices for selling puts on price expansion and contraction in combination with volatility. And again, I'm going to link some stuff in the description below so you guys can look up, if you're not familiar with options or puts, you can get an idea of sort of what I'm talking about with that. But anytime this stock drifts down like this is an expansion to the downside of price. And every time it does that, after a certain period of time, it will revert itself back to the mean, back to the middle. Doesn't mean it has to go up like this. It could revert back to the mean and then continue down. But what I'm doing is, every time it gets expanded to the downside like this, and we get this big push down, I'm expecting that over a short period of time, it's going to revert back to its mean, which is this midline right here. So what I want to do is say, okay, we're pushed down. Now, I don't think we're going to go any lower, so I'm going to sell a put, and I'm going to let this ride back up. And before it comes back down, my hope is that we'll be beyond the 30th of August, which is my expiration date right here. So today I saw this pushing down, and then this first red bar came in, which just indicates that there's been some slight movement back to the upside. So I'm just watching this now and expecting that we're possibly going to revert back to the mean. So that means over the next few days, we will probably trickle upward. And then if it decides to turn over and move down, that may take a couple of days. So my goal is by August 30th to have this expire worthless, meaning stay above 227.50. If this expires worthless, I keep the premium, nothing happens, and I move on. So with that being said, now let's look at the options chain. So when we come into the options chain, you can see I have all these selections in here, and I chose the August 30th expiration. And if we toggle down through here, you can see right here, here's my current position on this, and it's at the 227.50 strike. But this morning, when I put this trade on, I was getting $2.50 for the trade on the 227.50 strike. And one other thing I like to combine with this is this probability of staying out of the money. So this column right over here, this tells you with previous price action and volatility factored in, what are the chances that this contract is going to expire worthless, that it's not going to drop back below 227.50. And the probability of that on the 227.50 is about 85%. So really strong. There's a very high likelihood that it's going to drop back below that level and the contract will just expire worthless. So I went ahead and took that option. I sold one put, which 100 shares makes up one contract. So I sold one contract, sold a put, and got the $2.50 premium. So I made $250 premium today that I will keep no matter what happens, and I'm going to wait to see if this will stay above the 227.50. Now again, if it goes below my 227.50, as we were looking over here, if it drops back below this line before August 30th, I could get what is called assigned, which is where I will have to buy 100 shares of stock from someone else at 227.50. But the upside is, if I do get assigned on this, this is a stock that I would want to own at this low price. So it's actually sort of a backdoor strategy of being able to get a stock for a cheaper price. Now, if it never hits 227.50 and keeps going up, no big deal, I'm fine with it. But if it were to give me a nice deal, come down here and expire, I would not only keep the premium, but then I just got the trade desk for a cheaper price. So flipping back over here, I'm going to move myself out of the way for a second. If I come down here, you can see that you can get some numbers based on volatility. So this is another piece of the pie for me, is I like to look at the current volatility. And this morning, the implied volatility was up above 50%, which means that volatility had expanded. It was more volatile than normal. Now, when that happens, premium prices go up. So that $2.50, that was a result of the volatility being higher. Now, my hope is that over the next week, volatility will then start to slow a little bit. And if that happens, that means premiums are going to come down, and likely I'll be able to close my position out for a much less price than what I received for the premium. So let's say, for example, I got $250 premium to enter this, and maybe in a week's time, volatility's gone down, and now the contract's only worth 50 cents. I could then close it for 50 cents. And then overall net, my gain would be $2, not $2.50, because I would subtract the amount I took out to close. So that's kind of the idea for me. It's price expansion and contraction using the MACD, volatility expansion and contraction using implied volatility and implied volatility rank, which is this number here, which we can get into maybe in a later video. And then I like to also come and look at puts and calls, the ratio. So right now you can see there are more calls here, more contracts out for calls than puts. So this PC ratio right here of 0.68, anything below 1 is showing a more bullish sentiment. Anything that's well above 1 can be a more bearish sentiment. So I like to have this PC ratio below 1 when I'm looking to take a position. So I got good premium because of volatility, because it was up above 50% for implied volatility. I got some price expansion that was down, and now I'm waiting for it to revert to the mean and contract, volatility expansion, contraction, and the PC ratio. All of these things played a role in why I decided to take this trade today and collect $2.50 premium on 100 shares. I'm staying small. It's just one contract. That's all I'm doing, one contract right now. Now I'm going to watch and see what happens, and I'm going to keep you updated on this. Hopefully we'll get the next few days moving to the upside. We'll get reversion to the mean here, and then hopefully we'll just expire worthless. So that's my trade breakdown for today. It's on the trade desk, ticker TTD. I hope you enjoyed the breakdown. If you want to see more of my specific trades, whether they're just stocks or options, let me know in the comments below. I'd love to hear your thoughts on that. And if you took a trade on the trade desk, let me know about it. And we'll see you tomorrow.